Vanakkam, Namaskar, and hello to all the viewers and listeners of this edition of Fixed Income Markets with Sundaram Mutual Fund. The month gone by has been largely supportive of the bond story, with overseas limelight being hogged by the debt ceiling drama in the United States. As expected, the higher base setup in the last year due to the supply constraints and profligacy of developed nations and the fall in commodity prices, especially energy prices and metals on account of slowing global growth, the inflation momentum has slowed down, with most developed economies showing a deceleration in the headline inflation, although still far off from the 2% target they aim for. In general, the inflation momentum is slowing down across the globe, giving headroom to central bankers to slow the rate of hikes or pause altogether. Although the message is that more data on inflation is needed to send a signal of victory over inflation. In India, the RBI governor has indicated that the policy actions have been working as the inflation readings are coming off, and barring the caveats on El Nino and other global events in case they occur, induce inflationary pressure, the inflation is likely to moderate further. Basis this, we believe that the central bank in the upcoming policy will hold the repo rate at 6.5%, as the year ahead inflation is expected to be in the vicinity of 5%, giving a real return of over 1 to 1.5%, which is restrictive enough to keep the inflation spilling over into the wider economy. On the domestic economy front, the high frequency indicators continue to be robust, like GST collection, PIM numbers, GDP growth, credit offtake, etc. More on these on detail on these will be available in our detailed outlook, monthly outlook. Although some slowdown in manufacturing activity has been there, which could be seasonal in nature as well as related to external sector weakness, in our opinion, although higher rates have yet to completely work through the economy, the pause from the Monetary Policy Committee has come at the right time, giving the economy a fillip as market participants pencil in a future path of lower interest rates and not hold back on pools of money, making it easier for entities to raise monies in the market. With government expenditure tilted towards capital expenditure, it's trying to get in the private investment to take advantage of this virtuous cycle. Indian domestic economy is doing well, and any significant downtick in the global economies can bring down the overall trend growth of around 6%. In this backdrop, we think that Monetary Policy Committee will look to hold the rates for longer, allowing the productive sectors of the economy being supported by managing the system liquidity. In this backdrop, we also continue to reiterate our preference for mid-duration buckets as a preferred way to add duration. In the mid-duration bucket, we prefer 5-year maturity over 3-year maturity, barring any individual investor who has a more conservative approach can be in the 3-year bucket to add duration. At this, as the likelihood to capture the moves on the longer end of the curve entails liquidity risk in comparison to mid-duration bucket, which results in most cases a suboptimal outcome on account of entry and exit timing. As an example, consider due to liquidity, say on the mid-duration bucket of 3.5 years, an investor is able to capture 60% of the 100 basis point down move, while on the long duration bucket of 7 years duration, the move of 70 basis point, she's able to capture 40%. The return generated in absolute terms due to MTM is 2.1% for mid duration, while it is 1.96% for long duration bucket. Well, the outcome is not very significantly different in terms of absolute return delivered, but based on the risk taken, the long duration outcome is inferior to the mid duration outcome. Keeping this in mind, we recommend investors to take positions in mid-duration buckets if they have 12 to 18-month horizon. An investor with conservative risk appetite match their investment horizon with duration of the product or take position in conservative products like liquid or overnight. With this, we come to an end of this episode and see you in the next episode. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.